As we head into the new trading week, with the U.S. markets currently closed this Sunday, October 19th, 2025, all eyes are fixed on Beyond Meat. The stock concluded the last trading session on Friday, October 17th at just $0.65 per share. That move, however, was a staggering gain of $0.13 or 24.15% in a single day. Now, seeing a 24% jump on a screen, perhaps on your Fidelity mobile app or Robinhood watch list, the immediate temptation is to think this is the bottom. The easy assumption is that the long-awaited, painful turnaround has finally begun. But here is the reality that isn't being discussed on social media. A move like that on a stock this close to zero is rarely a signal of fundamental recovery. It is a signal of desperation. It's the classic hallmark of a short squeeze, amplified by algorithms and day traders, not a sustainable shift in the business. This 24% move is, very likely, a trap for hopeful investors. For years, the common belief surrounding Beyond Meat was that it was the next great disruption. The expectation, fueled by a high-flying IPO and endless media coverage, was that this wasn't just a food company. It was a technology company that was going to fundamentally alter global protein consumption. The narrative was that adoption would be a one-way street, that supermarkets would clear out the old guard to make way for this new, efficient, and ethical product. Investors who bought in early, perhaps using a straightforward Robinhood stock trading account or a SoFi Invest platform, were looking at it like the next Tesla stock or Nvidia stock, a true category definer that would deliver exponential returns. The reality, as we've seen, has been a brutal collision with consumer habits, persistent inflation, and absolutely intense competition. The market expected a smooth, tech-like ascent. It got a painful, real-world lesson in the cutthroat, low-margin realities of the food industry. That 24% pop on Friday? It's just noise against the deafening backdrop of an existential crisis. The stock is down over 99% from its all-time high. This one-day spike changes nothing about the core problems. Let's analyze that Friday session, because a 24.15% gain doesn't happen in a vacuum. The first question any serious analyst asks is, what was the volume? Was this move backed by massive, high-volume institutional buying, the kind that signals a real change in sentiment from smart money? Or was it, as is far more likely, a move on relatively thin volume, exacerbated by algorithmic trading playing ping-pong with a heavily shorted name? Given its sub-dollar price, Beyond Meat is dangerously close to delisting territory, which itself attracts a certain type of high-risk trader. This is where sophisticated players, maybe using the Interactive Brokers trading platform for complex option strategies, are betting against the retail crowd trying to catch a falling knife. They see this 24% jump not as a buying opportunity, but as a perfect opportunity to initiate new short positions at a slightly higher price. The macroeconomic environment remains absolutely toxic for a company like Beyond Meat. The expectation was that premium products would always find a market. The reality is that for the last 24 months, the consumer has been relentlessly squeezed by inflation. When shoppers go to the grocery store, they are trading down, not up. They are choosing the cheaper store-brand ground beef or the 10-pound bag of chicken, not the premium-priced plant-based alternative that costs significantly more. This isn't a failure of the idea of plant-based meat, it's a failure of the economics in this specific high-pressure environment. The company has no pricing power. If they raise prices to cover their own rising input costs, their sales volume collapses. If they cut prices to compete, their already thin margins evaporate completely. This is the definition of being caught. It's precisely this kind of single-stock volatility that many people opt for managed online investment solutions, like Schwab Intelligent Portfolios or building diversified baskets through Fidelity ETFs. The self-investing route is tempting, especially with the accessibility of platforms like SoFi, but the Beyond Meat chart is a brutal case study in what happens when a story stock meets a harsh economic reality. Then there is the competition. The initial expectation was that Beyond Meat, with its first-mover advantage and powerful branding, would have the field largely to itself. The reality is that the grocery aisle is now a war zone. Impossible Foods remains a fierce, well-funded private competitor, but perhaps more dangerously, traditional food giants, the Nestle's, the Tysons, the Conagras, all launched their own plant-based versions. They already have the manufacturing scale, the massive distribution networks, and the relationships with retailers. They can afford to treat plant-based as a small, experimental category within their massive portfolios. For Beyond Meat, it is everything. They don't have a multi-billion-dollar legacy business to subsidize their experiment. This is where we have to look at institutional activity. Are large funds buying this 24% dip? We have to look at the 13F filings, though they are lagging indicators. The truth is, many long-term funds, the kind that might use Fidelity Wealth Management services for their clients, likely liquidated their positions months or even years ago. What's left is often a mix of index funds who must hold the stock as long as it's in the index, and opportunistic hedge funds treating it as a speculative trading vehicle. This is the kind of stock that many investing sites might still feature on most volatile lists, but the professional money looking for stable, long-term investment is often heading for the exits. Comment below with your thoughts. Do you believe Beyond Meat can secure new financing or a strategic partnership before it's too late? Or is this the end of the line for the company as a public entity? For those who are new to this story and are just seeing the 24% headline, what does Beyond Meat actually do? The company was founded on the concept of creating plant-based meat substitutes, burgers, sausages, and ground beef, primarily from pea protein. The goal was to replicate the taste, texture, and sensory experience of traditional meat, targeting not just vegans, but flexitarians looking to reduce their meat consumption. The business model relied on a two-pronged strategy: get into retail, supermarkets, and get into food service, restaurants. For a while, the expectation was that this model was working perfectly. They had massive headline-grabbing partnerships with McDonald's, Yum Brands, KFC, Pizza Hut, and Starbucks. The reality? Those partnerships were tests. The market priced them in as permanent global rollouts. But the products didn't move in the volumes needed. The McPlant test in the US was quietly discontinued. Other tests were scaled back or never expanded. These food chains are ruthless on margins and performance. A product has to earn its place, and the Beyond Meat products largely failed to do so at scale. This isn't like Apple stock, where a new iPhone launch is a guaranteed high-margin revenue stream. This was a series of costly experiments that failed to convert, leaving the company with massive production capacity and no one to sell it to. Many people who opened their first individual brokerage account, perhaps with Fidelity or Robinhood, bought this stock during its post-IPO hype. They were sold a tech company. The Fidelity trading platform and Robinhood app made it easy to buy a few fractional shares. But the homework that was missed was on the balance sheet. The real story of Beyond Meat for the past 2 years has been its cash burn. The company has been burning through cash at an alarming rate to fund its operations, marketing, and R&D. Their quarterly reports have been a sea of red ink, with revenues declining year over year while losses mount. That 24% pop on Friday does nothing to fix the negative cash flow. It doesn't refill the coffers. The company has had to take on significant debt, and at these stock price levels, raising capital by issuing new shares is almost impossibly dilutive and difficult. This is the reality that clashes with the expectation of a simple stock bounce. The company is fighting for its very survival. So what happens next? As we look to the future, we have to consider the possible scenarios, all framed by this tension. Path A, the bearish reality. The 24% jump was a dead cat bounce. The company continues to burn cash, fails to secure new financing on acceptable terms, and eventually files for bankruptcy protection, wiping out equity holders. At 0.65, the market is pricing this in as a very high probability. Path B, the Hail Mary acquisition. Is it possible a large traditional food conglomerate could buy them out for pennies on the dollar? Perhaps. They could acquire the brand name and the patents for a fraction of their former cost. This might provide a small payout for current shareholders, but it would be a tiny fraction of its peak valuation. The 24%